Imagine putting up like the absolute best numbers of your entire career. You're breaking league records, you are executing the game plan flawlessly,
Right.
and yet you are getting relentlessly booed by your own home crowd like every single time you touch the ball.
That's brutal.
It is. And that is exactly what is happening to Uber right now.
Yeah, it really is the ultimate disconnect between, reality and market perception. You have a company that's operating at peak efficiency, and the market is treating them like they just fumbled on the 1-yard line.
Welcome to today's deep dive. If you've been watching your portfolio and wondering why a company that is quite literally printing money is suddenly down over 23% over the last 52 weeks, you're probably incredibly frustrated right now.
Oh, absolutely.
We're looking at a mega cap tech giant that has finally achieved the holy grail of gig economy profitability. I mean, Wall Street begged Uber to do this for years. They did it, and their stock is getting hammered for it.
Right. We're looking at a classic growth at a reasonable price setup,
Yeah.
commonly known as GERARP.
Yeah.
But, this particular GERARP setup is wrapped in a thick, suffocating layer of market pessimism. So right now, Uber's trading at 65.94 cents, and it is heavily testing its 52-week low. The psychological weight on this stock is just immense right now.
So our mission today is to basically cut through that psychology. We've pulled together a massive stack of their fundamental financial data, geopolitical market sentiment reports, and honestly some really fascinating under-the-radar insider trading activity.
Yeah, that insider data is wild.
It really is. So we need to figure out if the broader market is accurately pricing in a looming disaster, or, if this is a massive mispricing opportunity that you should be paying very close attention to.
And to figure that out, we really have to start with the fundamental reality of their balance sheet. Because, well, before we can understand the panic, we need to understand the machine they built.
Let's get into those numbers because they are staggering. We aren't talking about a scrappy startup anymore. If we look at their trailing 12-month revenue growth, it is sitting at a highly robust 18.31%. Outpacing 18% growth at their sheer market cap size is, frankly, incredibly difficult to do. But the real headline for me isn't the top-line growth, it's how much of that cash they are actually keeping.
Exactly. The efficiency pivot is monumental here. For a decade, the dominant narrative was that Uber was just a structural cash incinerator.
Oh, totally. Just setting venture capital on fire.
Right. But that narrative is entirely dead now.
Yeah.
Today, their trailing 12-month gross margins are 35.54%, and their net margins have reached 15.91%.
Let's just pause on that. A nearly 16% net margin in the gig economy.
Unheard of.
This is an industry where margins have historically been notoriously razor thin because, you're constantly subsidizing labor to keep the network alive. It shows a definitive transition into a highly profitable, mature platform.
It does. And the metric that really cements that maturity is their GAAP earnings per share, which currently sits at $4.0241.
Okay, I want to dig into that specific GAAP number because it isn't just an accounting vanity metric, is it?
No, not at all.
Because we constantly hear about tech companies touting, adjusted earnings, but GAAP is the gold standard. Why is hitting positive GAAP so crucial for a company like this?
Well, it comes down to stock-based compensation and heavy depreciation.
Mm-hmm.
Historically, gig companies pay a massive portion of their corporate talent in stock options.
Right.
And then they just back those out of their adjusted earnings to make the numbers look better.
Which is a neat little trick.
Yeah, very convenient.
Right.
But GAAP generally accepted accounting principles. It forces a company to count those stock options as a real expense. So hitting $4.02 in GAAP earnings means Uber is genuinely profitable, even after accounting for all the complex tech sector financial engineering.
Which fundamentally changes who's actually allowed to buy the stock.
Exactly. This is the hidden catalyst here. There are massive institutional pension funds and endowment mandates that are legally bound by their bylaws.
Meaning they have strict rules on what they can touch.
Right. They are strictly prohibited from investing in companies without a proven track record of positive GAAP earnings. So by crossing that threshold, Uber has essentially unlocked the door to trillions of dollars of institutional capital that literally just couldn't touch them 2 years ago.
Yet, despite unlocking that door, we look at the valuation and the market is yawning. I mean, the price-to-earnings ratio, the PE, is sitting at an astonishingly low 15.65.
Yeah.
That brings their PEG ratio, which factors in that 18% growth rate we mentioned, to well below 1.0. If a company is generating an implied $8.5 billion in net income annually based on these numbers, why is Wall Street treating them like a speculative, high-risk gamble?
Basically because Wall Street doubts their stamina. Executing on a dual mandate, meaning simultaneously delivering high revenue growth and high profitability, is incredibly rare.
Usually you have to pick one.
Exactly. Usually, a tech company has to sacrifice margins to buy growth or, sacrifice growth to harvest profits. So the market is looking at that 15.65 PE and essentially saying, we see the $8.5 billion, but we fundamentally do not believe you can defend it.
I see.
But mathematically, trading at that low of a multiple with 18% growth creates what technical analysts call a capitulation setup.
Meaning everyone who wants to sell already has.
Right. The market has temporarily exhausted its selling pressure purely based on negative sentiment, completely ignoring the fundamental fortress the company has built.
Okay, so the financial engine is clearly humming. But in the tech world, as soon as you print a 16% net margin, you basically paint a giant target on your back.
Oh, absolutely.
Competitors see those profits and they want to eat them. So how is Uber actually preventing a price war from eroding that margin?
They are relying on an evolution of the traditional network effect. Economists call this the three-sided network effect. It's no longer just riders and drivers. It's riders, drivers, and local merchants, like restaurants and grocery stores.
Let's break that flywheel down visually for the listener.
Yeah.
How do those three sides actually interact in the real world to, block out competitors?
Okay, think about the daily life cycle of a single driver. In a two-sided network, a driver takes commuters to work from, say, 7 a.m. to 9 a.m.
Sure.
And then they just sit idle, making no money until the evening rush hour. But at the third side, the merchant. Now that same driver drops off a commuter at 9 a.m. and immediately starts delivering lattes from a local cafe, and then shifts to delivering pizzas from a local shop at noon.
So the local pizza shop gets access to a massive, hyper-efficient delivery fleet without having to hire their own drivers.
Yep.
And the driver stays constantly busy and earns more per hour, which keeps them loyal to the Uber app. And I guess the rider gets lower wait times because the driver never actually left the neighborhood.
Precisely. They all reinforce each other, which drives down idle time, and idle time is the ultimate enemy of gig profitability. But the absolute crucial detail here is that this network effect doesn't scale globally. It scales block by block.
Wait, I'm going to stop you right there and play devil's advocate for a second.
Go for it.
Let's say I go to a massive private equity firm and they give me $1 billion in venture capital to start a rival ride-sharing app. If I just launch in Manhattan and offer rides that are like 20% cheaper than Uber, why doesn't this entire fortress crumble?
It's a logical assumption, but it ignores the brutal reality of local density. Let's play out your scenario. You have $1 billion, you offer a rider a cheaper fare.
Right.
But to fulfill that ride, you need a driver. Since you don't have passenger volume yet, you have to pay the driver a massive hourly subsidy just to keep your new app open.
So I'm bleeding cash immediately.
Hemorrhaging it. And even with $1 billion, you are spreading that capital across an entire city. If a rider opens your new app and sees a 25-minute wait time because you only have 50 cars in all of Manhattan, they're going to immediately close your app and open Uber to get a car in 3 minutes.
Even if Uber costs $5 more.
Exactly. Convenience always beats a modest discount in this sector. You don't just need a good app. You need crushing local density in every single neighborhood you operate in.
Which means I have to bleed my $1 billion street by street just to get my wait times down to 3 minutes. And historically, Wall Street has entirely lost its appetite for funding those kinds of localized, cash-burning trench wars.
Right.
I mean, that is exactly what destroyed well-funded early entrants like Sidecar or Via.
Exactly. The moat isn't the technology. The moat is the localized liquidity of human movement. And Uber is actively compounding this advantage through their super app strategy, which bundles mobility, delivery, and freight into one unified ecosystem.
This cross-pollination is where the data gets genuinely fascinating. If I download the app just to order Uber Eats on a Friday night, statistically, I am vastly more likely to use Uber for my ride to the airport the following week.
Which fundamentally alters the unit economics of the business. By bundling the services, Uber drastically lowers its customer acquisition costs. Pure-play competitors, let's say Lyft, which only does rides, or DoorDash, which only does delivery, they have to spend marketing dollars to acquire a customer for one specific utility.
Right, they pay for that single transaction.
Yeah. But Uber acquires the customer once and monetizes them across multiple daily needs, capturing a significantly higher lifetime value per user.
And they aren't just resting on the U.S. market either. They are actively buying density abroad. In July 2026, they announced the acquisition of Delivery Hero's Foodpanda brand in Taiwan. Out of everywhere in the world, why aggressively consolidate in Taiwan?
It is a strategic strike for Asian market density.
Mm,
Historically, a competitor named Grab has held a strong advantage in that broader region.
right, Grab is huge there.
Very huge.
Okay.
By acquiring Foodpanda's Taiwan operations, Uber isn't just buying immediate revenue, they're buying the underlying fixed cost infrastructure. They absorb Foodpanda's driver networks and map them onto Uber's proprietary routing algorithms.
Oh, wow.
Yeah, by overlapping those two systems, they strip out the redundant overhead, which should rapidly expand their segment margins in that region within just a few quarters of the deal closing.
Speaking of stripping out overhead, we definitely have to touch on the internal operational leverage. They recently executed an AI-driven workforce reduction specifically targeting their customer service departments.
Yeah, that was a big move.
I know layoffs are a harsh reality, but purely from a margin perspective, utilizing proprietary AI for support automation dramatically reduces the fixed cost of every single transaction on the platform.
When you pull back and look at the whole board, the execution is brilliant. They have achieved impenetrable local density, they bundled services to slash acquisition costs, they are buying regional dominance, and they are using AI to relentlessly automate overhead. The fundamental fortress is structurally sound.
So they've built this impenetrable local fortress, but you can have the strongest walls in the world, and it doesn't matter if the threat is coming from inside your own camp or from massive global macroeconomic shocks.
Very true.
Let's talk about the dark clouds, because I was looking at the intraday charts, and the stock recently skidded 4% in a single session, breaking below its 52-week low to hit $65.56. If the margins are this good, what are the specific potholes blowing out their tires right now?
There are two very distinct catalysts currently terrifying the market. The first is a direct threat to the long-term technological narrative Wall Street bought into.
Okay.
The Financial Times recently published a report indicating that Waymo is actively exploring walking away from its robotaxi alliance with Uber.
That is a staggering headline. I mean, Uber's entire futuristic pitch to investors has heavily leaned on partnering with Waymo to eventually transition away from paying human drivers.
It's a major narrative fracture.
Yeah.
And the second risk is entirely macroeconomic. We're seeing severe military escalation in the U.S.-Iran conflict, specifically resulting in naval blockades at the Strait of Hormuz and the Bab el-Mandeb Strait.
And just to clarify for you listening, we are looking at this conflict purely through the lens of macroeconomic data and supply chains. We are just tracking how global friction translates to the bottom line here.
Right. And the direct consequence of those specific Middle Eastern blockades is that Brent crude oil briefly surged above $100 a barrel before settling near $97.
Which is incredibly high.
Exactly. When fuel costs spike that violently, it degrades the underlying unit economics for the drivers, which historically suppresses consumer demand as rides get more expensive.
So to put this in perspective, management is currently navigating a nightmare road trip. You're driving down the highway, your smartest navigator, Waymo, just threatened to jump out of the moving car, and oh, by the way, the price of the gas you need to finish the trip just doubled overnight.
That analogy perfectly captures the market's current panic. Wall Street sees the navigator unbuckling their seatbelt, they see the gas gauge flashing, and they just hit the sell button.
Right, they panic.
Yeah. But as analysts, our job is to distinguish between a structural impairment to the core business and what is merely a transitory, sentiment-driven headwind.
So let's dissect how management is actually handling these twin threats. Because when you dig into the operational data, it becomes very clear they aren't just sitting in the boardroom panicking. Let's tackle the oil spike first. If gas is $97 a barrel, how is that not eating directly into their 16% net margin?
Because Uber is not a traditional transportation logistics company that owns its fleet and eats the cost of fuel. Their entire platform is governed by a dynamic pricing algorithm designed to balance real-time supply and demand.
Surge pricing.
Exactly. This means that when macroeconomic shocks cause fuel costs to rise, the algorithm largely passes those exact costs through to the riders via localized surge pricing.
Ah, I see. So if it costs the driver $20 more to fill up their tank, the algorithm quietly bumps up the cost of the ride by a few dollars to ensure the driver remains incentivized to stay on the road. Uber's bottom line is insulated. It's the end consumer who ultimately absorbs the geopolitical shock.
Precisely. And furthermore, if we look at the super app model, their delivery segment is structurally far less exposed to fuel costs than mobility. A massive percentage of global food delivery happens via bicycles, electric scooters, or very short-distance low-speed trips.
That makes a lot of sense.
So the diversified app provides a natural internal hedge against crude oil volatility. Not to mention, recent diplomatic mediation talks suggest the geopolitical risk premium on oil might be pretty short-lived anyway.
Okay, so the gas price pothole is highly manageable, if not entirely mitigated. What about the navigator jumping out of the car? If Waymo leaves, does the autonomous dream die?
Well, this is where we look at how management hedges its bets. Even as the Waymo partnership looks fractured, and it is worth noting that negotiations seem to still be actively ongoing behind closed doors, Uber has already secured an alternative pathway.
Really?
Yeah, they are a major backer of Travis Kalanick's new $1.7 billion robotics and autonomous venture.
Wait, Travis Kalanick, the original founding CEO of Uber.
The very same.
That is a fascinating full circle moment. So they're keeping their foot firmly wedged in the autonomous door through a secondary channel, regardless of what Waymo ultimately decides to do.
Exactly.
But this brings me to my absolute favorite piece of data we uncovered for this deep dive. It's the hidden signal in all this noise. While the broader market is panicking over Waymo headlines and oil charts, and the stock has been dragged down 18% over the last 6 months alone, we pulled the Squeeze Watch insider data.
Oh, this part is so telling.
It really is. Over the trailing 90 days, insiders at Uber have made a net purchase of positive 36,120 shares.
What is genuinely fascinating here isn't just the net positive number. It is the structural breakdown of those transactions. There were actually fewer individual buy transactions, 97 buys, compared to 157 sell transactions.
Wait, let me make sure I have this math right. More individual insiders are actively selling their stock than buying it, but the net overall share count being acquired is hugely positive. How does that work?
It reveals the conviction levels within the company hierarchy. The high number of sell transactions typically represents lower-level employees or mid-level managers who receive stock as compensation.
Right.
And they are cashing out small, routine lots for tax purposes, or to buy a house, or simply to diversify their personal portfolios. But the buy transactions, while fewer in number, are massive in scale.
Meaning the big fish are buying.
It means key executives, board members, and high-conviction insiders are making concentrated heavy purchases.
They are looking at the exact same headlines the market is panicking over, looking at their 15.65 PE ratio, and quietly backing up the truck to load up their own personal portfolios at these depressed prices.
They are betting their own capital that Wall Street has the narrative entirely wrong, and major financial institutions agree with them. Goldman Sachs just recently named Uber one of its absolute top equity picks for 2025.
Wow.
Yeah, this raises a fundamental question that punctures the entire Waymo panic. Does Uber even actually need autonomous vehicles right now to be a great investment?
And looking at the numbers, the data screams no.
Exactly. Their core business of mobility and delivery is already generating that 15.9% net margin purely by utilizing a human-driven network. Autonomous vehicles aren't required to sustain their current profitability. AVs simply represent massive optionality for future margin expansion.
They are a bonus, not the foundation.
Exactly.
And when you look at how the stock is actually trading day to day, it completely backs up this theory of technical exhaustion. The volume regime ratio is currently sitting at 0.86 times the 3-month average.
Which is a vital metric to track right now.
Let me put that metric into perspective for a second for the listener. Think of a sell-off like a crowded theater where someone yells fire and everyone rushes for the exits. That rush creates massive volume.
Right.
A volume regime ratio of 0.86 essentially means the stampede is over. The theater is mostly empty. The weak hands and the panicked algorithmic traders have already exited the stock. There isn't a fresh flood of new sellers rushing in to push the price lower. It is just a few stragglers quietly leaving.
That is a perfect analogy. It is a textbook technical exhaustion pattern. The downside risk appears to be very firmly defined and capped right here at these 52-week low levels.
Okay, let's pull all of these threads together to give you a clear roadmap. We're looking at a highly unique multi-quarter setup. If you are a day trader looking for a quick pop by Friday, this probably isn't for you.
Definitely not.
But if you have a 6 to 12-month horizon, the picture is compelling. Uber has fundamentally transformed from a cash-burning startup into a highly profitable, cash-generating machine protected by an ironclad, hyper-localized moat. The broader market has punished the stock relentlessly due to headline fears about Waymo partnerships and Middle Eastern oil prices.
Yeah.
And this has dragged a company growing revenues at 18% down to a valuation that is undeniably cheap.
The downside floor is well defined by technical selling exhaustion, but the upside is where it gets really interesting. If we simply see a natural re-rating back to a standard tech sector PE ratio as these transitory headline-driven fears begin to fade, The technical targets sit firmly between $85 and $95 a share. Yeah, from current levels, that represents a potential asymmetric gain of roughly 29% to 44%.
It is a massive mispricing opportunity, assuming, of course, that management continues to relentlessly execute on that dual mandate of growth and profitability. But before we wrap up today, there is a broader, almost philosophical concept hidden in this data that goes far beyond just a 12-month stock price target.
Yes. And it is something that really reframes the way you look at the future of infrastructure. Think about what we've unpacked today. Uber has managed to achieve this staggering level of logistical efficiency and financial profitability while relying entirely on a network of human drivers.
Right.
These are human beings who need to sleep, who get fatigued, who get stuck in unpredictable traffic patterns, and who require expensive fuel to operate. And yet this single super app is already dominant enough to optimize the daily movement of goods and millions of humans.
Which begs the ultimate question.
Exactly. What happens to the physical landscape of our modern cities and the structure of our daily routines when this entire optimized network eventually, inevitably, transitions to autonomous technology? What does a city look like when the marginal cost of moving a physical object or a person across town drops to near zero?
It really makes you wonder if Wall Street is currently this short-sighted booing a star athlete who is putting up record numbers while fighting through headwinds. What are they going to do when that same athlete suddenly evolves into something that doesn't even need to stop and take a breath?
It is going to be incredibly fascinating to watch this transition unfold over the next decade.
It absolutely is. Thank you for joining us on this deep dive. Keep your eyes on the data, ignore the noise, and we will catch you next time.